Good afternoon, everyone, and welcome to another special event here at TradeStation as we introduce Karen Smith of OptionsANIMal. She's a top instructor there, and she's going to talk to us today about income trading using the Iron Condor. Karen began her trading career back in the 90s using mutual funds as her primary trading vehicle. She managed her portfolios while acting as controller of her family's business, and she was very successful with those methodologies, but she became frustrated with mutual fund fees. We're all always looking for better ways to do business, aren't we? And she knew that options afforded leverage, and she became very interested in the concept. And so over time, Karen has developed into a top instructor at OptionsANIMal, and she feels privileged to be part of the coaching team there, and we feel privileged to have her with us today at TradeStation, so I'm very excited. Now remember that everything that we talk about here at TradeStation with respect to options is for educational purposes only. All the symbols and all the trading ideas that we discuss are for demonstration purposes. They're not recommendations. It's not an offer or a solicitation of any kind in a jurisdiction where any TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading carries a high degree of risk. It may not be suitable for you. Now, I've posted into the chat panel 2 pieces of disclosure information about various asset classes that we trade here at TradeStation, and I urge you to take a look at those at your leisure. Certainly, you can click on the link and it will open in another browser window for you. Right about now, everyone wants to know, are we recording, and when will the recording be available? We are recording, and I do have great confidence that our presentation will be in place on the TradeStation YouTube channel sometime tomorrow, and so that you can take notes while Karen's speaking. You can certainly review her presentation tomorrow. I want to turn things over to Karen Smith of OptionsANIMal right now so that we can talk about income trading using the Iron Condor.
Thank you, Don, so very much, and thank you for that wonderful introduction. Good afternoon, everybody. Please accept my apologies for the little bit of a late start. Technical difficulties here. Fortunately, I have more than one computer, as most of us who are traders do, and so we managed to get one of them to work today. I hope you're having a lovely afternoon and had a good day today in the markets. Just to reiterate, of course, that along with TradeStation, what I share with you today should not be considered as a recommendation to buy or sell any security, all information being intended for educational purposes only, and no way should be considered investment advice. Options, of course, involve risk and aren't suitable for all investors. All rights and obligations of options instruments should be fully understood by individual investors before entering any trade. So when I was asked to do this special webinar with you today, at OptionsANIMal, I was asked, what would I like to talk about? And I thought, well, I'm looking back on all of my years of trading, starting self-taught in 2008. That year might ring a bell for a few of you. That was the last great bear market we had, losing way too much money at that time, and then finding OptionsANIMal myself as a student in 2009. Learning really how to trade, how options function in the marketplace. And I've seen a lot of evolutions, versions of this market in all of these years. Of course, we're still in this very long-term bull market run. And I thought, what are some of my favorite trades? What are my go-to sorts of trades in the marketplace? This happens to be one of them for a variety of reasons. And I thought, well, let's spend some time together this afternoon talking about that. What I'd like to start out with first is get to know you for just a moment. So if I could ask you, do you at present time have familiarity with this trade called the Iron Condor? If you could just type a quick yes or no there into that chat box, this will give me a good sense of where I want to focus the bulk of our time. And I can see we've got some experienced traders with us. Not surprised to see that today. Many of you have experience with this trade, and I've got a few of you who do not. So let me share with you what it is that you're going to see today. We're going to start with the basics, review for some of you. in terms of what is this trade we call an Iron Condor. You're actually going to see slides from the third level of our curriculum. That happens to be the level at which we teach this particular trade. We have 8 levels of our curriculum in its entirety. We'll talk about the types of equities, the types of scenarios that present interesting opportunities for Iron Condors. We'll look specifically at the pieces of this trade, how we put one of these trades together, and what sort of the risk, reward, and probability metrics look like for this trade. You know, every trade that you place, it's all about the management of risk, reward, and probability. I literally 30 minutes ago finished teaching a class for OptionsANIMal. I am an instructor, have been for the past 6.5 years, and we were discussing that in great detail in this particular 6th level curriculum class, where we were talking about how to select trades based on the management of those very things. So we'll get into that today. And then, as I do have a lot of you with experience, I'm going to take you a little bit maybe deeper down the rabbit hole, is what I like to call it, in terms of looking at this trade and some rather interesting sorts of applications for this particular trade. So even if you have experience, please stay tuned, because I think that you're going to learn a little bit today in terms of what we have to offer. And then I do have a special offer for you regarding becoming a member of our fantastic community at OptionsANIMal. So let's talk about this trade, the Iron Condor. First of all, we are selling premium for profit. You know, options are limited life assets. They're wasting away, in essence, day by day by day. Now, that wasting away of premium can actually provide profitability to us in our trades, as it does in this particular trade, the Iron Condor. There are other trades that we teach where we actually purchase those options, that premium, for profitability. That those trades have different risk, reward, and probability parameters to them. But this is a trade that involves selling premium for profit. Options are utilized as insurance policies. Some of you may even use these options as insurance policies. For example, if you sell a call against shares that you own of an equity, creating something called the buy right or the covered call, you can insure your shares against any sort of pullback or bearishness that could come to play, for example. We can purchase a put as an insurance policy, because when we purchase a put, it gives us the right to sell shares. What we're doing in this trade is we're actually selling that insurance to someone else. And you know, when you take a look at insurance companies, one thing we know for certain, and that is that they're not going to go broke taking in those premiums, are they? They're betting on the fact that most of the time when they insure us against various events, most of the time we don't collect on that, do we? We don't collect on our auto insurance, our homeowners insurance, etc. Well, that's exactly what we're doing here in this trade in the option world. We're going to sell premium to someone else with the expectation that they're never going to collect on it. In this case, that our underlying equity is not going to go beyond the strike of the options that we are selling. We get to keep the premium we collect, just like that insurance company, and that's profit to us in the trade. So what we're actually doing is combining two individual trades that we teach here at OptionsANIMal in the third level. We call them the bull put and the bear call. Those of you with spread trade experience, you know these as selling a put vertical and selling a call vertical. We're putting those two trades together. Those happen to be the class numbers 3.3 and 3.4 for those particular sessions. What is our expectation in this trade? That an equity is going to remain range bound. It's going to finish within a certain range by expiration. One of the attractive things about this trade is that we don't have to so very specifically pinpoint the exact level to which an equity may rise or fall in a given time frame. Yet we can be profitable, quite profitable, in this trade. I like that. Some of you might be really good at being able to forecast that. What I have found over the years is that the more specific we have to be in terms of that forecast, the more challenging it is to actually be spot on. So here we have this range available to us for profitability. This gives us strong likelihood, strong probability of success in this trade. So in terms of putting these pieces together, we are selling or shorting a put at a higher strike price than a put that we are purchasing or going long. That is that bull put spread. Then we are also adding a short call and a long call, with the short call being sold at a lower strike price. than our long call, and that's what creates that bear call or selling that call vertical side of this particular trade. Here's what the profit and loss graph looks like for an Iron Condor. We like to call this one the pilgrim hat inside our options animal community. It does kind of look like that, and it will be Thanksgiving before we know it. So there you can see where you have that range for profit right here across the top. This area right here, that's the maximum profit potential in this trade. Our equity valuation is here across the bottom. Okay, so once again, if it finishes anywhere inside this range, we have maximum profitability on this particular trade. Our reward is going to be a combination of both sides of the trade, two credits, in other words, the credit from the put vertical side and the credit from the call vertical side. Now, in terms of the risk in this trade, the risk will only be based on one side of this trade. And that's because at option expiration Friday, whether that be 7 days from now or 70 days from now, whatever the case may be, at expiration Friday, this underlying equity, Netflix, Micron, Nvidia, whatever the equity is, it can only finish at one value.
Let's go to your
and that
speech last
value
night.
at which that equity
Were
finishes
you
determines
were
profit
you
or
addressing
loss
the
in this
president
trade,
or
assuming,
Bannon
of course,
or
we
the
take this
group in
trade all
total?
to
I think
expiration Friday. Well, the equity can't go so low as to cause the put vertical side of the trade to go to loss, and at the same time move so high that the call vertical side of the trade goes to loss. That's not possible. So in an essence, we're guaranteed that one side of this trade does in fact go to a profitable conclusion. And that is why the maximum risk and therefore the margin that gets set aside by your broker on this trade will be based on one side of the trade. Now, the interesting thing about this is that we do not have to make this look the same on both sides. In this particular example, our profit and loss graph shows that it is a mirror image. If this was a flat piece of paper, you folded it in half, you would see both sides are the same. What this means is the spread, the difference in our strike prices is the same. Maybe it's a $2.50 cent wide spread on both sides, maybe a $5 wide spread, but it's the same. We don't have to do it that way. We could choose, I like to call it, to lean one direction or the other. Let's say we're a little bit more concerned with bullishness, as the markets do continue to be bullish. We're concerned about this selling this call vertical. So maybe we want to keep this side at a smaller spread, but actually widen the spread to some extent here on our put vertical side. Okay, what we do by it, what we are accomplished by doing this is we get to take in more credit here by widening that spread, which gives us the potential for more profit in this trade. Can you see that I'm having challenges drawing with this crayon? You could probably tell that that's not the greatest dollar sign, but you hopefully get the gist of that. So you do have the ability to do this should you choose to. If you do that, then the side with the greater risk will be the determinant in terms of margin withheld as well as potential profit and loss in the trade. Okay. Break-even points, upper break-even. I call this the bullish break-even. This would be the case where your equity actually runs through the strike of this call that you have sold. So this break-even point right here is going to be that strike price of the short call plus the credit. In other words, once the equity moves far enough that you've given back your credit, that's your break even. If it continues to move to the upside, that is when you experience loss. The lower or bearish break even will be just the opposite, and that's going to be our short put strike minus our credit. Now, if the equity is anywhere between these two break even points at expiration, we are going to have some profitability. So what that means is, yeah, it may go a little bit beyond the short put strike, could also go a little bit beyond the short call strike, and we can still have some degree of profit. And in fact, if it stays inside that range, above the short put, below the short call, we actually do, as I said, get maximum profitability in this trade. Okay. In terms of looking at each side of this trade independently, let's start with what we call the bull put. Again, those of you with experience know this is selling a put vertical. And as I said, these are slides from the curriculum, so you have the opportunity to see exactly how it is that we teach all of the different 20 plus actually different trades that we teach inside our curriculum. So here with our short put, keeping in mind when we sell this option, we are entertaining the potential obligation to purchase shares of the underlying equity for the dollar value of the strike of this put. Again, why do we do this? Because we expect that the equity will move to the upside, and as it does, this put that we sell will lose premium. As it does so, we get to keep that premium that we collect. That is our profit potential in that particular option. We work with a bullish to stagnant trend. That's what's available to us for profitability, and we sell this put at the bid price or the wholesale price. To this, we add our risk limiting instrument. That's what spread trading really is all about, the ability to get the leveraged returns that you're looking for in your portfolio, but to do so in a way where you're always hedging risk. You're identifying, quantifying, and hedging risk in these spread trades. So we add this long put, giving us the guaranteed right to sell shares of the equity at the dollar value of the strike of this put. We buy this option at the ask price or the retail price. Now, we know in reality that we can work the bid and ask values, of course, in that spread. So once again, we're working with a bullish to stagnant trend on this trade. The reward is the credit that we generate. That's the most we can make in the trade, and the risk is the spread, the difference in our strike prices minus that credit. So that is the bull put side of this trade. And then, of course, for the full Iron Condor, what we're going to do is add, I like to call it the twisted sister, if you will, in terms of that bear call or selling that call vertical. So we sell a call. This short call gives us the potential obligation to sell shares of the equity at the dollar value of the strike of this call. This short call will make money for us if an equity is stagnant or bearish. The short call loses premium, and that loss of premium is profit to us in that option. Now we know that when it comes to short calls, that one of the issues we have, big issue actually that we have, is that it is impossible to know the exact amount of risk in a short call. And the reason for that is because there is no absolute ceiling or cap on how high an equity can go, right? I mean, take a look at Netflix, for example. Netflix reporting earnings actually, fell a few dollars today on earnings. I think it was just a lot of good stuff had already been priced in to Netflix's shares. But until today, there seemed to be no stopping point. NVIDIA, another example, right, in the marketplace right now. Amazon, with equities that continue to move to the upside. So because there is no ceiling or cap, the risk in a short call, a naked short call, one that we sell by itself, in other words, is indefinite. We can't quantify it. And that's why your brokers won't allow you to do naked short calls inside your IRA accounts. Okay, it's too much risk. So we want to use the short call in the trade. We simply add a risk limiting instrument in the form of this long call, keeping in mind that the long call gives us the right to purchase shares of this equity at the dollar value of the strike of this call. Okay, and so we use it as our risk limiting instrument here in the trade. The reward, of course, is the credit we generate in the bear call, and the risk is the spread minus the credit. So we get two credits that we put together in these two trades for our Iron Condor. And as I said, the risk will be based on one side of the trade, the widest spread that you have minus the net credit of both sides of the trade put together. One of the things that makes OptionsANIMal unique, better than others, and I can say that, full circle for me, I joined as a student, I graduated the curriculum, and now have the pleasure of being an instructor here for the past 6.5 years. So I've seen all sides of this. One of the things that we do that others simply don't, and we really do it exceptionally well, is planning our trades. We have a 6-step lather, rinse, repeat process that we actually teach in the curriculum. 6 repeatable steps that we use again and again and again for consistency. That's why 90% of our trades that we place are closing profitably. And we have trade results that we're happy to share with you if you're interested in hearing about that. Part of the reason is right here in front of you. And that has to do with planning what we call primary exits and secondary exits. This is actually step 4 of that 6-step lather, rinse, repeat process. one of the things that comes to play, and if you're honest, you probably have experienced this in your own trading, I certainly have in mine, is that we can get either greedy or fearful. Emotions, right, come into play. We're emotional beings. The way that we work with this is right here in the planning of the trade. You do your most objective, critical thinking about your trades before you place them, before they're live, before there is any real risk out there, risk of loss in a trade. So we want to plan not only for the good, okay, when do we take profits, how do we take profits, but we also plan for the possibility that in this particular trade, the equity gets too much trend. It starts to move too strongly either to the upside, to the bullish side, or to the downside bearishly. So right here, in terms of determining those exits, the primary exit for your trade is it's usually the easy one. It's what is it I'm looking to achieve? Well, we want for our equity to stay within our short option strikes, and this is my favorite. This is what I do whenever possible, and that is closing this at a percent return on risk. Consider closing this a few days before expiration. JR, you've got a question you're asking out there about using weekly options or even doing the same day of expiration with the option. Okay. First of all, the challenge with that, JR, is going to be that the shorter the duration of the options that you're using in your trade, the closer you're going to have to be in terms of where you set your strike prices, the closer you're going to have to be to where your equity is trading. And that's because of the way that premium decays, which I'm going to talk about actually in just a few slides, the way that premium decays on an option chain. Because you have to be so close to where the equity is trading, your probability of success on the trade is going to be rather low. Is it possible to create a trade and get really great returns out of it if everything works perfectly? Sure, it's possible. But you will have way less than a 50% chance of getting that profit out of that trade. The other problem is this. This is a trade that can work beautifully for an extended period of time. And then at the very last moment, because Amazon announces that they're going to acquire Whole Foods, you own Costco, and Costco moves down 10% in a day. It's not an earnings move, right, which we can forecast and predict and prepare for, but it's sort of that black swan event type scenario. This happened to me. This is why I speak about it, right, earlier this year. Those sorts of things, while they don't come to play all the time, they can come to play anytime. And what you find happening is you can have a whole series of very short-term trades, weeklies, in fact, with this sort of trade. But it only takes one going completely against you that way to wipe out profits from many of these trades that you've placed. So while I want to get excellent returns, I want to get leverage returns, double-digit returns, in fact, on these trades, I don't typically place them in such a short duration. Are there exceptions to that, JR? Sure, there are exceptions. For example, I traded Netflix today with this trade after earnings. And I'm going to talk about why I did that in just a few slides when we do start to talk about premium and premium decay. So I appreciate the question, and I hope that that was a good answer for you there. In terms of secondary exits, again, escape hatch, parachute, what can I do? How can I do it? This is the planning up front for the just in case scenario, so that if you get to that point, you know exactly what it is you're going to do and how you're going to do it. No emotions involved. As I mentioned from the profit and loss graph, we do have the ability to close this at that theoretical break even or at a percent loss. Now, what I typically do, I don't like losses. Losses limit profitability. So I want to make adjustments to this trade. That's another piece of our 6-step lather, rinse, repeat process that is so very vital. And that is the ability on these trades to make adjustments, to take losers and turn them back into winners. It enables you to get those 90% success rates inside your trading in a very bearish trend. So it's the short put here that's getting into trouble in our trade. Well, depending upon the degree of bearishness, we could go in and add a long put. By adding a long put, it's sort of like a tourniquet, if you will, that stops the bleeding. Okay, long puts, of course, I'm going to speak Greek for just a moment. have a negative delta. And a negative delta means they make money as the equity is moving negatively or bearishly. So by adding this long put, what we do is we say, okay, we're going to change the trade dynamic here so that we have the ability to make money if our equity is in fact becoming bearish. We can take possession of the stock and collar trade it. This is a trade that we teach in the 5th level of our curriculum. The collar trade is a share ownership-based trade. Earlier I said that when we sell this put, it gives us the potential obligation to purchase shares. So in that instance, what we can do is, I call it the natural secondary exit. We could place an Iron Condor on an equity that we desire to own. Let's take Netflix. Again, just because Netflix had earnings in the news, had some really great things to say, by the way, in earnings. Subscriber growth, exceptional, all kinds of fantastic things happening, lots of brokerage upgrades today, all sorts of things. So, you could have gone in today, this morning, for example. The high point for Netflix, I think, was at about, 203-ish, something like that this morning. You could have gone in and purchased shares, or you could establish a trade like this, where you're going to take in this credit. And the idea is, if your equity does fall the way that Netflix began to do throughout the course of the day, and it falls beneath your short put strike, you're actually going to buy the shares at a discount. I like a discount. I'm always trying to find a discount. And if you do this, the credit that you take in on this trade, you get to keep that. And what it does is it lowers your beginning cost basis in your shares. And this is actually the trade that brought me in as a student myself to OptionsANIMal in April of 2009. And the reason for that, again, we'd had that great bear market. I lost way too much money in that event. And the collar trade is a trade that actually can make us money in all trend scenarios. And what I mean is, you can own shares in a bearish trend, and by hedging them with options, you can actually make money in the bearishness. You can position your options in such a manner that they make more for you than what the shares are losing. This is kind of the great game changer, as far as I'm concerned, when it comes to trading. So you could use this as a secondary exit. You could also take the trade and move it. Stay with your same Iron Condor structure, but move it out of the money and further out in time. I cannot tell you how many times this has been a very successful adjustment for me in these trades, particularly when I do these trades on the ETFs, the exchange traded funds for the major indices. And JR, you were asking about S&P options. You can do this with the actual index options, or you can do a trade like this on those exchange traded funds. So for example, I like to use, or have historically, I should say, liked to use the SPY. The SPY is the ETF for the S&P 500, for example. The great thing about ETFs, and they don't have to be just for the indices, it could be something like the XHB for home builders, for example. Or the XLE is one that I like to trade for energy, for example. You don't have earnings, right? You don't have these times when you can get sort of the 10% move in a 24-hour window of time that we contend with when it comes to our individual companies or equities. So ETFs can at times be really great candidates for this trade. So to roll it means we're going to reposition. We're going to go further out in time, and we're going to perhaps reset those strike prices. In particular, if it's the put side, because of bearishness that's getting into trouble, we're going to move that put vertical to lower strike prices. Many times when we make this adjustment, we actually have the ability to take in a larger credit than what we began with in our original trade, which means we have the potential to make an even better return with just a little bit of added time in this adjustment. It's not a blanket adjustment for each and every scenario, but many times it's a very effective adjustment or secondary exit on this trade. In the case of bullishness, so it's actually the call vertical side that's getting into trouble, we can add a long call. This is where we would add positive delta to the trade with our long calls. Again, a tourniquet to stop the bleeding if our equity is being too bullish, or we can take this trade, roll it out of the money, and further out in time as well. Eduardo, let me repeat and answer your question. Would you close the trade a few days before expiration even if the price is right in the middle of your short strikes. You're trying to avoid transaction costs. Yes, to answer that question. Eduardo, sometimes here's what I will do, okay? I will leave my long options, particularly if those long options, because remember, this trade was never based on those long options, right? Those long options are risk limiters. So if I have a situation, it's a few days, like you say, a few days before expiration, and my long options out there, they're 2 cents, something like that. They really don't have any value to them. Then what I will do is I'll go in and close my short options. Those are my obligation options, right? Obligation to buy or sell shares. I'll close those and I'll leave my long options as sort of a lottery ticket. Now, why do I say a lottery ticket? Because if it is the Friday where Amazon announces that they are acquiring Whole Foods, and let's say that you'd been in an Iron Condor on Costco before that happened, and you had done that. You had closed out the short put, and you had this little long put sitting out there that was, out of the money, pennies on the dollar. Well, if you were to happen to get a really strong move like that at the very end of the trade, it's possible that you could have additional profit in a situation like that by having those long options out there in place. So that's something I do a lot, Eduardo, where instead of paying commissions, and a lot of brokers don't even charge commissions if it really is, sort of that 2 cent or 3 cent per share sort of value. But that's one way, if you do get charged commissions, that you can reduce those costs. So I hope that that's helpful for you. Let's take a look at an example. And this is a really great chart for an Iron Condor. What we're looking for, again, is a range. And we've certainly seen, this year's been very bullish for the broader markets and many equities as well. But there are these periods of time where we consolidate, right? You make a big move to the upside or even to the downside. For example, the oil space earlier this year was a sector that was having some bearishness. You make this move and then you spend some time. It could be a few weeks. It could even go into a few months, depending upon the situation, where your equity or your ETF is consolidating the big move that's already come to play. That can be a really interesting time, that consolidation phase, for this particular trade. So here we've got an equity that is very range bound. We have resistance. This is sort of this topping point. The equity can't quite get through this level, which happens to be at about $66 on this chart. And then support. Support is just the opposite. It's actually the entry point for buyers. The equity falls to a certain level, and then buyers come in and send these shares higher after that point. So what we want to do is we want to establish a trade where we're selling our options outside this range. Short puts below support and short calls above resistance. That's what we're looking for. So in this theoretical example, 32 days. Now, the question that JR asked about using weeklies. Can you use weeklies? You can. Okay. And again, as I've said, and I'll illustrate even more specifically in a few minutes, there are some big caveats. I have found the sweet spot. Different trades have different sweet spots. If you've ever played tennis, you're probably familiar with the term sweet spot. It's, when you hit the ball right in the center of the racket and it makes that gorgeous sound. I don't know if any of you like to watch tennis. I do. And it's a beautiful sound when it's hit just perfectly. Well, our trades have that sort of a sweet spot to them. And each trade is different in terms of its sweet spot. This trade, about 32 days. I'm going to say 21 actually to 32 days is a sort of sweet spot. Now, why do I say that? Well, because when we're in this window of time, we have the ability, okay, to have a relatively, something like this, there's that sort of a pilgrim hat, right? We have the ability to have a wide range. Remember, equity value going across the bottom. A wide range of finishing points for this equity and for us to have maximum profitability. The shorter the duration we go, so if we do a weekly sort of trade, looks more like this, okay, where the range of possible outcomes for that equity and for us to have maximum profitability will be much narrower. Once again, I said it can be challenging to pinpoint exactly where an equity may go. I like to have a wide range, but at the same time, I want to be in a situation where my option premium is decaying fairly rapidly. because that's what we're taking advantage of, right? Theta, time decay. We're selling premium to others for profit here. So this is the sweet spot, 21 to 30 days. Why? Because when it comes to theta decay, it looks something like this. Okay, some of you have seen this before. This is that time frame, the last 30 to or 21, anywhere from 21 to 30 days or shorter. This is where options are getting decayed exceptionally quickly. We're taking advantage of that by placing the trade in this time frame. So in our example, what we're going to do on the bull put or the put vertical side, sell to open the out of the money, strike 62.50 short put for 34 cents of credit, buy to open the strike 60 long put for a 15-cent debit, total credit of 19 cents on this side of the trade. The bull put risk, we have a $2.50 wide spread minus our 19 cents of credit, and that's $2.31 of risk on this side. John, love it. John says that profile, that lovely profile, John, did you like that? That I drew there for that theta decay is only for at the money options. You're a step ahead of me, my friend. We're going to talk about that more specifically when we take the deeper dive. And you're 100% correct. Nice job there. All right. So let's talk about the bear call side for just a moment. On the bear call side, we sell to open the strike 67.50 short call for a 26-cent credit, buy to open the strike 70 long call for a 4-cent debit, total credit of 22 cents on this side of the trade. The risk on that side is our $2.50 wide spread minus our 22 cents of credit, or $2.28. So we get to put our two credits together, 19 cents on the put side, 22 cents on the call side, giving us a total of 41 cents of credit. Now, when it comes to identifying risk, remember, it's based only on one side of the trade. So we take our $2.50 risk minus our 41 cents of credit for $2.09 per share of risk in the trade. What's our return here? Again, assuming the equity does in fact remain inside this range, we keep our 41 cents of credit divided by our risk of $2.09 a share. That's a 19.6% return in just 32 days' time. Now, when you take that and you annualize that, meaning that every 32 days you place a similar trade that's going to give you this return, we're talking hundreds of percent per year on trades in this manner, in this version, if you will, that are going to give you probabilities that are going to be greater than 65% on average. Now, I like this. I like this sort of setup. 20% every 30 days or so, 65% chance of success. Like that a lot. And in particular, when I know that if my equity does move outside this range, there's nothing that says it can't, right? There is no absolute when it comes to trading. I have the skills in my back pocket to adjust this to a profitable conclusion, because it doesn't take too many losers on a trade like this to wipe out way too many profits. So our break-even points, our upside bullish break-even again, will be our short call strike plus our net credit in the trade. In this instance, our 67.50 strike plus our 41 cents of credit, 67.91. And then on the lower or bearish break-even point is going to be our short put strike minus our net credit, or $62.09. So you notice we've got a little bit over a $5 wide range that we're working with here on this trade. Now you have to take that. You have to take it back to your particular equity. How far and how fast does it have a tendency to travel in terms of seeing, does this appear to be a wide enough range for an equity? You know, not all equities travel the same, do they? You know, Tesla has a tendency to be more volatile in its movement than perhaps a Starbucks, for example. Okay, so different equities are going to give you different ranges when it comes to looking at placing this type of trade. I know I can tell from the comments, from the questions, I have a lot of astute traders here with me today, which I really, truly appreciate. One of the things that we do here at OptionsANIMal, and that you've probably done somewhat, at least on your own, is study the Greeks, right? These numbers, this delta, gamma, theta, and vega. These are the dollar and cent figures that tell us really critical things about all of our trades. They actually tell us the pathway to profits And then they also tell us the challenges that may come our way when it comes to positioning trades. So here's another example. Different equity, it's trading at $68.90. This is exactly what we're looking for, this sort of range-bound price action, beautiful setup for this kind of trade. In this example, 31 days of time. So the short instruments are a short 67.50 put and a short 70 call. Our risk limiting instruments are our strike 65 long put and our strike 72.50 long call. And this is an example. I like this in contrast to what we just focused on, where we're actually going a little bit narrower. We're going a little bit closer in this instance to where the underlying equity is trading. That's how we're able to get a credit of 72 cents in this trade. Okay, all pieces put together. Now, when you set a trade like this, where you have a $2.50 wide spread, you get 72 cents of credit on a risk of $1.78 for a potential 40% return. Is that possible to achieve? It is, but notice in this instance how tight that range is in terms of what it is that we're setting. Okay, we only have a $2.50 wide spread on our strikes. Now, an interesting opportunity, my friends, gets created like this around earnings time. This is not an ideal trade to place ahead of earnings, but you're going to want to very badly. Why are you going to want to place this trade ahead of earnings? What happens with premium ahead of earnings? What happens with premium ahead of earnings? So for example, if you'd gone in late last week on Netflix, okay, Netflix had this astounding run, all of these upgrades, everything coming in to this big earnings event that happened yesterday afternoon. Exactly. High implied volatility. Brooke, you say it exactly the way I say it. That's hysterical. Juicy premiums. That's exactly, you lick your lips, right? It's just, you can't help yourself almost until you realize there's a reason. There's a reason why the premium looks that way. And it is because we didn't see it with Netflix today. Netflix actually made a really small move compared to what was expected and what is typical for Netflix. Yeah, until you get burned, Kevin. That's a good way to say it. Until you get Lululemon, great example, that moves 17%, right, in 24 hours. And think when the forecasted move is closer to about a 10% move. Those things happen more frequently, by the way, than we think they will. So that's not the ideal time. This is a trade that can go to close to full loss really quickly when you get that sort of move. However, there's an interesting, I have found this year, 2017, there is an interesting opportunity that comes to play after earnings. And me, same as why insurance premiums go up in hurricane season, precisely because again, it's all about insurance, isn't it? We're selling insurance to someone else at that time. Do you want to do that ahead of a hurricane? Perhaps not. After earnings, the opposite happens when it comes to premium, right? And that is depending, of course, upon how much the equity does actually move, historic volatility that comes to play, how much it actually moves after earnings. We get a crush of implied volatility in options, but it doesn't happen immediately. It happens the fastest, the quickest in the options that actually contain the earnings event in them. So for example, for Netflix, that happened this morning on its weekly options as they started to really crush. An interesting opportunity for me this year, and one of my favorite applications of this trade so far in 2017, has been on companies like Netflix. So Netflix, Alibaba, Amazon, I haven't done it on Tesla. Trying to think of Apple, equities like that, particularly after earnings when they move to the upside. Okay, and this is really key because sometimes when they sell off, it's not the same sort of pattern. And this is where you go, Micron's another good candidate, where you go and you study your equities, the equities you use again and again and again inside your portfolios. But an interesting thing happens frequently. Again, there's never and always. That is that when it makes that upside move after earnings, it has a tendency to consolidate that for a period of time. Okay, so it may move up a little bit more Bollinger Bands start to extend, may move up a little bit more, but then many times what you'll find is a week or two of consolidation. Remember how I said this is a beautiful trade for consolidation. If you go in after earnings, implied volatility is beginning to collapse, but perhaps isn't completely collapsed out of the options, and you position in this sort of window, that 21 to 30-day window, you can sometimes find some really interesting opportunities for this kind of trade. So that is something that has worked really well for me this year on those sorts of names. Okay, there's that profit and loss graph once again. Very quickly, we want to run through, oh, nope, took that out. I was going to run you through the Greeks, but we can do that actually right here in terms of the Greeks. So let me ask you, my experienced traders, when it comes to delta on this trade, what do you expect if I tell you that I'm creating a trade that I want no movement? I want it to be pretty quiet, pretty stagnant, sideways. What type of delta do you think I'd be looking for on that trade? Would it be positive or negative? Would it be large or small? What would I be looking for in terms of delta on that trade? Yeah, low, very low, in fact, right, Kevin? Exactly, neutral, perfect. So what you'll find is if you're positioning this correctly, you'll have a positive or a negative, but it will be small. It will be a very small delta that you will be beginning with in the trade, because it's not a trade for delta. It's not a trade for movement. Okay, it's just the opposite. Now, what's interesting is gamma. Okay, gamma right here, gamma is the gas pedal for delta. It's the accelerator for delta. Okay, and so ideally we'd love to have a situation where we didn't have too much gamma, meaning, you know, if it does start to trend, then that's okay because our delta is not going to change. Well, that's unfortunately not the case here, right? Remember, risk, reward, and probability, they're all related to one another. This is a trade that actually has a very big gamma to it. And it's actually a negative gamma. And what that means is if you start to trend, if you start to move very far, very quickly, what's going to happen is you're going to develop a delta on this trade. But the delta that develops will be the exact opposite of the delta that you'd like to have. So for example, if the equity starts to be too bullish, and it starts to get close to or even run through your short 70 call in this example, okay? What will happen is you'll go from a trade with very little delta to a trade that's starting to establish a big negative delta, because when we sell this call, anytime you sell an option, you know this, I know, but you reverse the signs of the Greeks. For any of you who may be newer, I don't want to leave you out today. So we have a negative delta here. And what happens is the equity travels to or beyond this short call, this negative delta gets bigger. Well, we're getting a bigger negative delta, but we have a positive trend. That doesn't work. That's what takes us to a potential losing conclusion in this trade. So this is a very sensitive gamma trade. Back to the question we had earlier about weekly options. Do weekly options have big gammas? They do. Okay, options, again, weekly options, the only weekly options that are going to have very much premium to them are going to be very close in their strike price to where the equity is trading. They're also going to have very large gamma to them, meaning it doesn't take a lot of movement to cause that option to go from out of the money to in the money. That's what it's all about at options expiration. Is it out of the money or is it in the money? And it doesn't take very much movement if that strike price is very close to the equity to get there. So you have a big negative gamma trade in an Iron Condor, okay? And that can be a problem when you start to have movement. Theta, that's what we're taking advantage of here, right? We're selling premium for profitability. Every day that passes, all of these options are losing money. That's a good thing for us. We love the weekends is what I like to say on our credit trades, right? And then Vega. Vega is the Greek for implied volatility. In this trade, we actually have a negative Vega. And just to put that into English, what it means is that, you know, we're sewing in a credit, right? In this particular example, 72 cents of credit is what we're taking in. So it kind of looks like this. And that's all there is. Once we sew that credit in, that's all that we can make in this trade. Well, if we did this today, and then tomorrow or the next day, implied volatility on our options, the percentage of implied volatility on our options, particularly our short options, if it were to increase, that means that premium increases. Now, this is a trade based on the shrinkage of premium, not an increase of premium that could look like this, okay? And that can create the potential for a loss, particularly if we needed, for whatever reason, to close out this trade at that point. This is why I just mentioned about the Iron Condor after earnings, because right after earnings, it looks like this. And then as the dust settles, so to speak, it starts to look like this. And it can go from this point to this point just from a decrease in implied volatility without any time, without any equity movement either. And that's what you can take advantage of in those certain scenarios. Brooke, excellent question. Would you just keep rolling, just keep on rolling? Or at what point do you cut your losses? Excellent question. So back to the adjustments that I mentioned earlier. We teach an entire level, it's the 7th level of our curriculum, that is 100% specific to adjustments. Every one of the 20 plus trades that we teach is full circle in its methodology, meaning we teach you what the trade is, how to set it up, just like we're talking about today with an Iron Condor, the kinds of scenarios and equities that fit the best for the trade. Okay, that's really important as well. Time frames, as I'm saying, for the trade. Then we get into those adjustments. And as you saw, there are more adjustments, Brooke, than what I shared a few moments ago. But that gave you sort of a sense of where we're going with that. There are multiples. We teach a methodology that includes some very important key questions that you ask when it comes to adjusting, because we do have choices in terms of how to adjust. Okay, when we get into those specifics, you're right. You could, if you had a really strong trend that was starting to develop and you had a trade like this, you could have the possibility of continuing to roll and continuing to roll, and you're running in front of a bus, right? A trend is like a bus. You know, you can run in front of it for so long, but ultimately it's going to catch up with you. You know, it's better to jump on the bus, isn't it? If that's the trend, right? Jump on the bus and let it take you where you want to go. And so that's why we have more than just a rolling adjustment for the trade. Because sometimes if we get a true trend change, we want to change this trade to match that trend. Okay, really great question, by the way. Now, before we get to the special offer, I said I would take you deeper down the rabbit hole. So for those of you who are newer, I don't want this to be overwhelming to you. I know a lot of you have some experience, so I think you're really going to enjoy this part where we take that sort of deeper dive. But rest assured, wherever you stand at present time, in terms of this trade, using options in general, having that methodology, this is what we do. This is what we teach and how we teach it. The way I'm teaching you today is exactly the way that I teach inside the classes here at OptionsANIMAL. So I'm going to give you a little analogy. It's going to be it's probably going to remind you a little bit, if depending upon how long ago it might be for you, of SAT questions. Remember those SAT questions that say this is to that as that is to this? Those things, right? Well, that's kind of what we have here on this little bit deeper dive on the Iron Condor. So it goes like this. Time is to an option's probability, likelihood, of being in the money at expiration as melting ice is to a polar bear's ability to roam. Now remember, this is important. This in the money at expiration is important because that's what risk in options is all about, right? It's the risk that you have to buy at a higher price than where the equity is trading, okay? It's the risk that you have to sell shares at a lower price than where the equity is trading, in particular with our short options that are part of this Iron Condor. That's where risk is, and it's all about where that equity finishes at expiration that determines the outcome for our options. So it looks sort of like this, okay? When there is time on that chain, here's our polar bears, okay? Our polar bears are our equities and potential outcomes, potential prices for our equities. So in other words, with a lot of time, this guy could go back here, and this one back here could move here, and so on, and so they could exchange places, so on and so forth, because we've got lots of ice and lots of time, okay? And that's why when we go out on an option chain, and we go out 90 days, or we go out 120 days, and we look at options that sit significantly out of the money. When I say significantly, I can mean 10, 12, 15%, let's say, depending again upon the equity, out of the money. And yet there's actually premium out there on those options because it's like this, it's this ice. Because there is, given more time, there's a greater chance that the equity does move and change its value. Now, when we're working with our weeklies, and remember I said that we would get to this more specifically in a few minutes. Well, this is now. Here we are, my friends. Here's our weekly options, okay? I don't know where we come up with these pictures, but it's a good one. So here's our weekly options. Here's our equity, right? You know, we're counting it down. Do you realize when you're working with weekly options, and I do use them, I don't want you to think that we don't teach you how to use weekly options. I have weekly options in my portfolio as we speak today, okay? So we do use them. But we have to understand that when we do use them, we're here, okay? We're in a position where our strikes are really, really close to where this guy is, because these are the only strikes left that have any premium. When we're working with a weekly option, we're only talking about 32 hours of time. If you start on Monday morning and you take it all the way to Friday afternoon at the close of the market, because of course options are only bought and sold in the regular market hours, that's all we're working with. That's not a lot of time, right? So that's why it looks like this. Out of time, nowhere to go. When we're out of time, the price of that underlying equity is known, and so the extrinsic value, the risk capital that we're working with, is gone. So here's another way to look at that. Okay. So imagine this is an at-the-money option. You have an equity trading at $150. This is your strike 150 call or put at the money. And then what we do is we go out of the money from this, out of the money or into the money from this position. Okay, so we can have an option that's 5% in the money or 5% out of the money, 10% in the money, 10% out of the money, so on and so forth. Okay, that's what these percentages refer to. So the extrinsic value reflects the market, the option market's expectation about whether or not an option will expire in the money with real advantage, real material advantage, intrinsic value we call that, or out of the money. That's what it's all about, okay? The greater the uncertainty of how far that equity will travel, like at earnings, for example, the greater the risk that it could actually go up or down 10 or 15 or 20%. So the more risk capital you will have to work with, extrinsic value, in these options. At expiration, since there's no more uncertainty, we find out exactly where the equity finishes, there's no more extrinsic value for out of the money options at that point. So it kind of works like a rubber band, okay? What happens as we increase time? The more time to trend, the more time to change the equity, to change its value from where it sits today to any of these other places on the option chain. So if we have a month, let's say, okay, it's like a rubber band. If we're working in that 30-day window or so, now this is all theoretical, but we're working with options. Again, here's the at the money position. Maybe we're working in a window of plus or minus 6.5%. These are the options, the strike prices in here that will contain extrinsic value to work with. Okay, these options out here won't have. They're the ones that you see on the option chain for 2 cents, 3 cents, something like that. Now, if we go further out in time, so instead we go to a 60-day option, for example, the rubber band increases. Okay, so now there are going to be, and I should probably have left those strikes on there from the first rubber band, but now there are going to be additional strikes that contain extrinsic value, once again, that are further away from where the equity is trading. What if I go out 3 months? Well, we extend again. And once again, further away from where the equity is trading, and there is still some extrinsic value to be had. And then finally, 4 months out, even wider. Now, why is this interesting? Well, some of you want to trade weekly options. You want to be very active and aggressive. Nothing wrong with that, by the way. But some of you might work another job. You might have other hobbies and endeavors. You still want to get these double-digit returns in your portfolio. You want to do it in a manner where you don't have to sit and watch every tick. You don't have to babysit as carefully. You can take advantages of scenarios where you do get increases of implied volatility and know how to trade that. Things of this sort. This can be a really attractive scenario to you because you can position when you go out a little bit further in time. You have the ability to position further away from where the equity is trading, giving you the opportunity to proactively make adjustments if you choose to do so, to not have to watch and babysit as carefully either. Because it works like this. Options decay from the outside in. Now, what do I mean from the outside in? Well, when it comes to option time decay, the options that are at the money, and this is what we were referring to earlier, when I drew that graph and I said, okay, here it is, right? Time decay? Yes. And it was correctly identified by a member of this community that, yes, that's true, Karen, for at the money options. But what about options that are 20% in the money or 20% out of the money? When do they start to decay most quickly? Much, much sooner. So if we're out here in the 4-month window, let's say, okay, and we've got these options, right, that are significantly far away from where the equity is trading, and in particular, we're working with out of the money options here. Significantly, a call that's 17% above where the equity is trading, a put that's 17% below where the equity is trading, for example. Okay, and we're 4 months out in time. There's a little bit of premium out here. When 1 month passes, so that option goes from being 4 months in time to 3 months in time. Take a look at what's already happened. You see this? These options out here have already experienced the bulk of their theta decay. We position them 4 months out, it's 3 months out. Already they've experienced that. What if another month goes by? These are the ones that you look out and see for pennies on the dollar. So you have an opportunity to position some of those iron condors in a fashion that enables you, yes, the duration may say 90 days, or it may say 120 days, but it doesn't mean that you have to be in the trade for that duration, particularly if you have a situation where your equity is very range bound and theta comes in much earlier on those options, decays them, and you have the ability to be in and out of these trades in 30 to 45-day windows for fantastic returns. In particular, when you find situations where implied volatility has elevated and you can go in and establish those trades, it's a big winning scenario. 2015, my friends, the markets were flat. S&P 500 in 2015, okay, 2 years ago, was flat on year. That's the August when we had that big waterfall sell-off in August. I was actually in Europe for the first time ever when that occurred. I was on a train from Rome to Florence when that occurred. But that big waterfall, but other than that, it was not a very volatile year, and it was a flat year. I used that trade I just showed you on the Iron Condor, wide Iron Condors, on the S&P, the SPY in particular. Double-digit returns throughout that year consistently with that trade, even in that aggressive sell-off that happened in August of that year. Okay, it's just a phenomenal application, and we teach all of that again in much greater detail inside the curriculum. So I do want to, and I kept you a little past our time as we did get started a little bit late, and thank you all so much for waiting for me again. Really appreciate that. So what I want to get to now is the special offer that we have here for our TradeStation community. You know, it's a real pleasure to be one of the educational vendors that gets the opportunity to work with TradeStation. And one of the reasons I believe that TradeStation likes to work with OptionsANIMAL is because, you know, your broker wants you to be successful. Brokers make money when we place trades. You know, we talked about from a trader standpoint, we sort of hate that we have to pay that. Well, it's a cost of doing business. Your broker wants you to be successful because if you are successful, then you trade a lot. You place those trades. They collect those commissions. But most importantly, if you're successful, you live to trade another day, which means you do not go in and blow up your trading account. They want to establish a long-term relationship with you. And what they have found from our graduates at OptionsANIMAL is that our community members are successful. And it's because of how we teach trades like the Iron Condor. It's because of the adjustment methodology that we teach for that and all of the other trades that we teach. And of course, how we teach you to understand risk, to manage risk, and when necessary, to change or mitigate risk. That's the key to long-term success. And I can say that being on all sides, full circle, with OptionsANIMAL. So the first 7 callers today are going to lock in a special discount, 25% off any membership that you choose to purchase with us. You'll have a free consultation. Now, I will tell you, you've spent over an hour with me today, which I truly appreciate. This can be a 2-minute phone call. If you don't have time to go through all the particulars today, it's okay, not a problem. We will set up a time to do that. At the same time, what we really want to do is we want to find out who you are. We want to find out where you've been in the markets. You know, what percentage of your trades are closing successfully? If you're not at that 90% metric, don't worry. I was not either. I was nowhere near that when I joined myself as a student. But that's where we want you to go. So we want to tailor a program to fit you, to help you, so that you can have the same success that we are having. Now, in addition to that, if you join us before this Friday, October 20th at midnight, we have a service. That's the trades that are closing at the 90% success rate. It's called the weekly trades. You will receive these absolutely free for the first 12 months that you are a member with us here at OptionsANIMAL. When I personally joined, I purchased those trades because I wanted to watch my instructors, some of who, by the way, are still instructors with us today. Our staff is amazing, very astute, successful traders in this community. I wanted to watch as they place trades in real time so that I could integrate what an Iron Condor was at the time as I was watching my fellow instructors place Iron Condors in the real market scenario at the time. It's just a wonderful learning tool that we have. Our phone numbers, 1-888-225-1155. If you happen to be an international presence with us today, that's your toll-free number, or 1-801-331-7500. Philip has a good comment, and I appreciate this. Further education. That's why we're here, Philip. Exactly. That's exactly the spot that we fill in the marketplace, is for those who want to apply themselves to a proven methodology. It's a matter of taking the classes, practicing, asking questions. That's the wonderful thing in our classes. We have live classes each and every single day. You have the ability to get your questions answered as you're going through and you're learning all of this information. So that you can really integrate it and begin to utilize it inside your portfolio. That's why we exist. That's why I'm passionate. Hopefully you've felt that today in our time together, passionate about having the opportunity to pay this forward to others the way that it was taught to me those years ago, and that I still continue to this very day to benefit from on a daily basis in my trading. So on behalf of OptionsANIMAL, again, many, many thanks to you. It's been a real pleasure to be with our TradeStation community. Dawn, it's always a pleasure to work with you as well. And we look forward to hearing from you. Pick up that phone and call. I promise you will be happy you make that choice. Thank you.